Every investor has different goals. Some want steady cash flow, and others want to maximize the upside. In this episode, John and I are going to be breaking down our A, B, C, D class shares and how it would affect you and your investment decisions moving forward so that you can make an educated decision of which one is best for you when you invest with Faris Capital Partners. John, it's great to be here with you.
So good. I'm so excited for this, Mark. It's something we talked about early on. And maybe in the time, we're first, it's like simpler sometimes is better, but we got a lot of feedback from our investors that were some that were just looking for the cash flow, right? And maybe the risk profile, was a little bit different, right? And so that's a big thing we do. We solicit feedback, right? We're always asking for feedback. So we actually ran a poll amongst all of our investors, and quite a few were looking for the stronger cash flow, hence why we created these share classes. So when you hear A, B, C, D, don't get intimidated. They're actually pretty simple and straightforward, but the purpose of today's podcast is to walk you through it so you have total understanding. So when our next deal comes, if you're interested in investing, you can make a really great decision that fits your investment profile.
You nailed it. And this is where we're very open to feedback. And as we're continuing to build Fair's Capital, we have this big goal to help 10,000 residents. And so we're well on our way to making that happen. But we collect feedback on an ongoing basis. And so the shift here in adding some share classes to be able to give diversity and to be able to further cater to our investors' goals, it really stems from this idea that we're open to feedback and we collect it from our actual investors on an ongoing basis. So this was actually caused because we've had a couple of investors say, hey, do you ever think of this? And do you ever think of that? And we're like, okay, let's create a survey. And so we surveyed our investors. And yeah, that's where we found that, as you mentioned, John, some investors really want to maximize the amount of ongoing, we'll call them mailbox money checks going to in their account. And so, or we'll call it milk money, so to speak. But in this case, it's actually a lot more than milk money coming in on a monthly basis with the investment amounts. But some wanted to maximize that out. And others said, you know what, we just want to maximize appreciation. So we don't really even care about those ongoing distributions. And there were many that said, we actually like both.
That's right.
And so, and in addition to that, we had some investors that were like writing these larger checks. And so we wanted to be able to offer some incentives for investors. If you're investing more, you're able to participate with more of the upside as well. So we're going to be breaking down all the share classes, and this will give you a good understanding of, okay, which one is best for me in my future goals, because everybody has different goals here.
That's it. Yeah, no doubt. So, the purpose behind these tiers. So we just touched on it. We surveyed our investors, but Mark, you and I are both lifelong learners, right? We go out and we study what others are doing. What we found is many, syndication groups or sort of general partnership groups don't offer these options, but a few groups that we really admire, that we either are close with or friendly with, or just watch from afar, that we notice are having a lot of success, we're offering shares like this. And so, we just go out and copy what works, right? And so that one size all fits all approach that some operators are doing, like, that's not what we want to be. We want to have something for everybody, make sure we're meeting everybody where they're at. This structure gives flexibility of cash flow versus equity participation, and frankly, some rewards for higher commitment. So we're going to dive into that in a little bit. But it also just gives our investors more control over how their capital performs, which is super critical for us. So yeah, let's dive in. So Class A, it is yield focused. So Class A is the class that sits just below the lender in the priority capital stack. So in other words, you get paid first in Class A. We're typically targeting a preferred return of somewhere between 10 and 12%. It is deal specific. We have to look at the cash flow and what the deal can support. So we had a deal at 10. An upcoming deal is actually going to be at 12. But what's happening is you're actually reducing your risk investing in this share class, because once again, you're actually sitting a little bit higher in the priority stack, in that capital stack. So you're actually trading a little payoff effectively for reduced risk. Now, once again, some investors are really excited about the 12%, that mailbox money or that milk money, as you called it, right? Maybe they're at that point in their life where they're looking to wind down the hustle a little bit and, enjoy the fruits of their success and have their money work for them while they sleep, right? So that higher cash on cash return is super attractive to them. So once again, the use case, this is ideal for investors who just want strong, stable income and reduce risk. It is a capped upside. It's just that return. But once we close or refinance, you get 100% of your initial investment back.
Hmm.
So it's just a great opportunity, once again, to get that enhanced cash flow while also reducing your risk a little bit.
You nailed it. And so, what does this actually look like? So, if you invest 100,000, that's our minimum in our deals, and we have investors coming in at 250, 500, a million. But let's just use 100,000 for easy math. That in this case, in the share class, you're getting anywhere from 10 to 12% per year. And so that means if you invest 100,000, you're getting 10 to $12,000 per year, and that's divided up over a 12-month time frame. So there's monthly distributions that are paid. And so if it's 12,000, that'd be $1,000 a month that's coming back to you. So you invest in US dollars, you get all your returns back in US dollars as well. And how we structure the distributions is return of capital. So at the end of the year, you don't have a tax consequence. The tax consequence is kicked down the road. The can is kicked down the road, so to speak, until we actually sell the asset. And then it's a capital gain at that point. And so this is we'll say a pure like cash on cash distribution play. And this works well when I look at the investors that this matches well up for, John, is somebody that wants to increase the quality of their life today by maximizing the amount of distributions or income that they're getting today. There are some other investors that they have their $4 million house that's completely paid off. And they said, you know what, we'd actually like to tap into that, and we're paying 5 or 6% on their home equity line of credit, and they're actually saying, you know what, I'd actually like to have the arbitrage. So I'm going to pull from my house, I'm going to invest it over here, I get 10 to 12%. That 10 to 12%, I'm going to be able to pay off my interest on my home equity line of credit. And not only that, the home equity line of credit you can use as a write-off. The interest that you're paying, you can use that as a write-off, so you get that benefit. You're getting the distributions back from the investment is all return of capital, and you're keeping the arbitrage between what you're paying in interest. So if it saves 5% and say 10 to 12% what you're getting here, and you're keeping the spread. And so those are the scenarios generally that this works out really well. This Class A share. Not only that, there's less risk in as well, because that's paid out first at the end of the day. So it's not for everybody, it's for some people, but for some people, if you check all those boxes of the things that we talked about are important to you, this could be a viable option for you.
That's right. So Class B is what we would say is sort of our standard passive investment. Now, by that, I mean, this is what we've offered on all of our other deals to date. So that typical preferred return, we offer an 8% preferred return. So the investor gets 8% of the return before Faris Capital sees a dollar. And then once we achieve an 8% IRR, we go to a 70-30 split, 70% favoring that limited partner investor. So you're getting 70% of the profit until we hit a 15% return in IRR. Then it goes to 50-50. So this is a balanced approach for investors who like the steady income, but also want to participate in the upside. So once again, this is kind of the standard approach to investing in a syndication apartment deal. And so it's a great fit for investors that are maybe early in their syndication investing journey or are looking to diversify by placing capital in multiple deals with multiple operators.
You got it. And so, John, just to kind of build on that 8% preferred return. So, the Class A shares are the 10 to 12%. So that's paid out first, and then it spills over. And then the Class B shares are paid out first. So generally, our deals are anywhere from like 5 to 6% ongoing distributions for our Class B shares. And so what happens is those are paid out on an annual basis. And then when we sell the asset, we top that out. We fill that to make sure that our investors are getting an 8% return. So it's like the first fruits of the deal. Second fruits of the deal, so to speak, after the Class A shares are paid out. Then the Class B are paid out. And so we top them off from 5 to 6% is typically what our deals look like on average. We top them out so they get an 8% return year over year. And then only after that does it go to that 70-30 until that 15%. But then here's the kicker. Here's why a lot of our investors like this option is because over a 15% internal rate of return. So that's an annual return. That means that there's a 50-50 split on the remaining profit in the deal all the way up. So there's no limit to what you can actually get in the investment. It's not like it caps at a certain amount. So a lot of our investors like that because they're like, okay, maybe I'm taking a little less cash flow. I'm taking 5 to 6 instead of 10 to 12, but I get to participate on the back end of this. And so that's where our investors know we're buying these at 20-30% discounts from the peak of the market. And at the end of the day, they're getting cash flow, but they're participating on the upside dollar for dollar or equal anything over a 15% return. And they're getting the first fruit still to be able to ensure that they're getting a solid return at the end of the day. So this is a good mix, as you mentioned, John, of cash flow and participation on the upside.
That's right. And it's worth noting, we mentioned A sort of sits a little bit higher in the priority in the capital stack, but B, C, and D are in the same priority, right? So when we get into C and D, you'll see it's really just about those investors that are investing a little bit more. And so we reward that because, a bigger investor, they're going to get a little bit of a bigger piece of the pie, so to speak. So same priority level. It's just a little bit of incentive to invest more. So those investors that invest more are going to get a better return at the end of the day. So let's dive into Class C. So Class C, the tier actually start at a 250,000. So say 250,000 investment up to $749,999. Preferred
99
return
and 99 cents too.
and 99
Yeah,
cents.
yeah,
Don't forget the 99
yeah.
cents. But the preferred return is the same. It's still that 8% preferred return. So everything we just talked about still applies. The profit split is 70 to 30. From 8% annual IRR to 15%. But at 15%, instead of that 50-50 that you get on Class B, it's actually a 65-35. So 65% of that profit above 15% IRR goes to the investor, 35% to Faris Capital. So we take a little bit less, but we're willing to give that up because obviously this investor believes big in what we're doing and we want to reward them for that loyalty and that trust.
You got it. Yeah, so it's pretty straightforward. It's just there's a little extra, and that generally that works out to about 1% on average per year. And so there's incentive there on that, and that's where spinning over to Class D. So investors we have that are over 500,000. In this case, it's 750,000 and more. There's a Class D that we've structured for those investors. So the 750, it's the 8% preferred return. And then from there, between 8 to 15%, it goes to an 80-20 split, 80 in favor of the investor and 20 for Faris Capital. So they're paid out faster there. And then anything over 15% rate of return, it goes to a 70-30 all the way up. 70% that goes to the investor and 30% to Faris Capital. So essentially these share classes are where Faris Capital is saying, hey, listen, we're going to take more from our plate to give to you and to the investors that invest more and commit more to it. And so that's where we really wanted to incentivize our investors there to that the ones that really believe in the deal and they have the ability to come in and invest. We wanted to be able to incentivize them as well. So
That's
those
right.
are the four different class shares, A, B, C, and D. And it really, the back two are really about the amount, and the first two is really about, is it cash flow or that's important to you, or do you like a combination of both that are in Class B shares?
That's right. So just to sort of recap, if you want strong cash flow and reduced risk, Class A is for you. If you want income and long-term upside, Class B. If you want more upside from your commitment, Class C. And if you want like elite level splits and scale, that's Class D, right? It's not about better. It's just about alignment with your goals and where, your future investment goals, you're wanting them to take.
You got it. So if you have any other questions, you can book a one-on-one call with John or myself. You can click on the link below and you can actually do that to ensure that you understand this. And generally what we find with our investors is that the very first deal when they come in, there's lots of questions. And so we welcome questions, and as long as it takes to make sure that you fully understand it. But the beauty is on the second, third, and fourth investment, we're finding with our investors that is just rinse and repeat. We're not We're not like coming up with a new business plan. It's just rinse and repeat of the same thing. And so John and I were really big, as John, you mentioned, in learning. And one of the gurus that we follow in leadership and business is Jim Collins. And he talks about this hedgehog concept. And so for us, this is this hedgehog concept that Jim Collins talks about, is doing one thing and doing it extremely well, and in rinse and repeat. Just like Bruce Lee says that he doesn't fear the man that can do 1,000 different kicks once. He fears the man that can do one kick 1,000 times.
Yeah.
And so that's what we're doing here. We have the value add play that we're doing, and it's rinse and repeat. And so far, of up to date, our 4 assets that Faris has taken from start to finish, we're overshooting our projected rent. So we're ahead of schedule, which is phenomenal. So the business plan is working, and moving forward, that's where, from a projection standpoint and our ability to execute on this, we're very excited and confident that we're going to be able to deliver on that business plan moving forward. So make sure that you check out all of our upcoming deals, and looking forward to jumping on a one-on-one call.
Yeah. And Mark, the way I think about those one-on-one calls, it's clarity. It's about clarity, not commitment, right? So booking that call,
Yeah, good.
not a sales pitch. We just want to make sure you have all the clarity. You can get all your questions answered so you can make a decision one way or another. That's what it's all about for us. So book that time in. We love talking with investors. And if it's not a fit for you today, maybe it will be in the future. And if we can add some value to you at the very minimum, then we're really happy about that. We're excited to do that.
Well, thanks for listening, guys. If you enjoyed the show, go ahead and subscribe to the channel. We love and believe in you guys. Keep dreaming and investing big.